The price they showed you this morning at somewhere in the low 5,000s came down. You saw it. And if you read anything about it in the financial press today, you were told the same story. Inflation data came in soft, the dollar firmed up, gold pulled back. Tidy, logical. Sarcastic wrong, not wrong in the way that the numbers are fabricated. The consumer price index for February 2026 did come in at 2.4% year over year, exactly as expected, with a 0.3% monthly increase. The Bureau of Labor Statistics published that data on Wednesday, March 11th. The dollar index did firm to 99.45 following the release, and yes, gold gave back some ground. Those facts are accurate, but the story built around those facts is missing the mechanism that matters, and the mechanism is sitting right now in the middle of the Persian Gulf. Pause burning. There are approximately 150 oil tankers anchored outside the Strait of Hormuz that cannot move. 20% of the world's daily oil supply, which the U.S. Energy Information Administration confirmed transits that 21-mile-wide choke point every single day, is effectively paralyzed. The International Energy Agency, the body that coordinates emergency oil reserves for 32 member nations, just authorized the single largest emergency release in its history, 400 million barrels. For context, that is 3 times the size of its previous record intervention. They did not do that because inflation is tame. They did that because the alternative involves Brent crude going to $200 a barrel, which is precisely what an IRGC spokesman threatened on Wednesday when he said, and I'm translating from the official statement here, that not 1 liter of oil would pass through that strait for the benefit of the United States or its allies. Here is the number that should have your full attention. The February CPI report, the one that moved gold down today, was compiled from data collected before February 28th, 2026. That is the day the United States and Israel launched joint airstrikes on Iran, killed Supreme Leader Ali Khamenei, and ignited a war that has now entered its 12th day. Every gasoline price, every energy cost, every shipping rate in that report predates the war. The March CPI report will not be published until April 10th. By the time the Federal Reserve is looking at real inflation data that reflects oil at $90 to $119 a barrel, the policy window will have narrowed considerably. And gold, which just dipped toward $5,064 today, is currently being priced against a backward-looking inflation number that has nothing to say about where prices are going. That tension does not resolve easily, and by the time we are done here, you will understand exactly why. Let me walk you through what is actually happening in the data, layer by layer, because the complexity here is real, and you deserve a complete picture rather than a headline. Start with the gold price itself. On January 28, 2026, gold hit an all-time record of 5,602 per ounce. From that peak, the market has been in a correction. The pullback was initially triggered by news that President Trump was nominating former Federal Reserve Governor Kevin Warsh to replace Chair Jerome Powell when his term expires in May. Warsh has a long record of supporting higher interest rates. The logic of the sell-off was straightforward. A more hawkish Fed chair means higher rates for longer, which raises the opportunity cost of holding a non-yielding asset like gold. COMEX margin requirements were simultaneously raised. Gold futures margins moved from 6% to 8%, silver from 11% to 15%, which forced leverage positions to unwind quickly. The result was a violent move. On January 30th alone, spot gold fell approximately 9% in a single session. That was the largest one-day decline in years. Standard Chartered's Suki Cooper, who heads global commodities research there, described both metals as having been trading in aggressively overbought territory at the time. So you understand what you are looking at. This is not a market where gold has failed. This is a market where gold ran from roughly $2,900 per ounce in early 2025 to $5,600, a gain of 93% in under 12 months, and then corrected. Since the correction, it has been slowly climbing back. On Tuesday, March 10th, gold futures for April delivery opened at $5,194 per ounce. By Tuesday's close, they reached $5,240. Then Wednesday's CPI data came out, the dollar ticked upward, and gold pulled back. The intraday low Wednesday touched $5,064. Now here is what the mainstream analysis of today's move is leaving out, and it is significant. The February CPI report contains a second structural problem beyond its pre-war data cutoff. Last autumn, the United States experienced a 43-day government shutdown that ran from October 1st through November 12th. During that shutdown, the Bureau of Labor Statistics could not collect data and used what is called a carry-forward methodology, essentially repeating prior data for October. That statistical gap is still working its way through the reported numbers. Economists at Fox Business, CNBC, and other outlets have noted this explicitly. The carry-forward data imparts a downward bias on inflation readings from December 2025 through approximately spring 2026, when fresh, undistorted data will start to override the gap. In plain terms, the 2.4% headline number is not only pre-war, it may be structurally understating current inflation pressure even before you add a single barrel of $90 Brent crude to the calculation. Meanwhile, across the Pacific, the People's Bank of China has now purchased gold for 15 consecutive months, a streak confirmed through January 2026. Beijing was also accelerating crude oil imports before the war began, with Chinese customs data showing a 15.8% year-over-year increase in the first 2 months of 2026. Tanker Trackers, the vessel monitoring firm, has confirmed via satellite imagery that Iran has already shipped 11.7 million barrels of crude oil through the strait to China since the war began, while the same strait remains effectively closed to vessels from the US, Israel, and their Western allies. The IRGC has formally stated that China and Russia may transit, everyone else cannot. This is the piece of information you are unlikely to hear on mainstream financial media today. The world's most strategically important energy choke point now has 2 sets of rules, one for the countries aligned with Beijing and Moscow, one for everyone else. The global oil market, which has been priced as a single unified system for decades, is being physically bifurcated in real time. What does that mean for gold? It means the debasement trade, which drove gold from $20,900 to $5,600, has now been joined by a second driver with entirely different characteristics. The first driver was monetary. Federal Reserve independence concerns, rate cut expectations, dollar weakness. That driver is interest rate sensitive. It responds to CPI data. It could be reversed by a more hawkish Fed chair. The second driver is structural. Energy supply fracture, bifurcated commodity markets, a shift in who controls physical delivery of the raw materials that power manufacturing across Europe, Japan, South Korea, and India. That driver does not respond to CPI data. It does not care about Kevin Warsh's rate preferences. It responds to whether tankers are moving through a 21-mile strait, and right now they are not. This is why the move today, the pullback toward 5,064, requires a different interpretation than a typical inflation-driven sell-off. There's a historical precedent for exactly this kind of misread, and it is worth examining because the parallel is structurally close to what is unfolding now. In October 1973, the Arab oil embargo began. Gold had been fixed at $42.22 per ounce, just 2 years earlier when Nixon closed the gold window. By January 1974, gold was trading above $180 per ounce, more than a 300% gain in 15 months. But here's what most people do not know about that episode. There were multiple sharp pullbacks during the rally, moments when inflation data came in ambiguously, when the dollar firmed briefly, when traders took profits. Each of those pullbacks was interpreted by mainstream commentators as evidence that the rally was over. Each one was a re-entry point. The parallel is not that today's situation will produce a 300% gain. The parallel is in the mechanism, an energy supply shock that predates its full appearance in official inflation data, combined with a central bank caught between 2 conflicting imperatives, fighting inflation and managing a weakening economy. The U.S. economy lost 92,000 jobs in February, according to the Bureau of Labor Statistics. That is not a strong labor market. That is a labor market that has already absorbed 175 basis points of rate cuts and is still contracting on a net basis. The Federal Reserve meets on March 17th and 18. CME FedWatch currently shows a 92% probability that the Fed holds rates at 3.5% to 3.75%. Every major market participant agrees, no cut next week. But the dot plot, the Fed's own projections for future rate paths, will be updated at this meeting for the first time since before the Iran war began. That update could move gold more than the rate decision itself. There's one key difference between 1973 and now that makes the current setup potentially more consequential. In 1973, the Federal Reserve's credibility was intact. It eventually broke inflation with the Volcker shock at enormous cost to the real economy. Today, the Federal Reserve is simultaneously navigating an oil-driven inflation surge, a weakening labor market, a leadership transition, and an incoming chair whose nomination has already created uncertainty about Fed independence. You can print contracts, you cannot print the metal itself. Now let me be direct about the strongest counter-argument, because it is a real one, and it deserves a complete hearing. The bearish case on gold today goes like this. Gold is already priced in significant geopolitical risk. From the low of early 2025 to the January 28th peak, gold almost doubled. Any rational market participant looking at that run must ask how much additional upside is left when the safe haven premium is already this large. Furthermore, the CPI data came in exactly at consensus, 2.4% annual, 2.5% core, which suggests the Federal Reserve does not yet have a compelling reason to pivot to rate cuts. Higher rates for longer do suppress non-yielding assets. And critically, the IEA emergency release of 400 million barrels, while unprecedented in size, does represent a coordinated global effort to cap energy prices. If oil pulls back towards $70 to $80 per barrel because the reserve's release works, the inflation fear premium in gold partially unwinds. Brent did fall from $119, $50 down to approximately $90 this week. That is a meaningful decline from the peak. The bears are not making a foolish argument. Where the bearish case falls short is in the timing of the data. The IEA's 400 million barrel release is a demand-side buffer. It does not move a single ship through the Strait of Hormuz. The Kepler Commodities Analytics firm, whose vessel tracking data the oil industry relies on, was explicit about this. A significant portion of Gulf spare capacity cannot reach global markets if the strait remains physically inaccessible. Saudi Arabia's East-West pipeline has a 7 million barrel per day capacity, and the UAE's Fujairah pipeline offers partial alternatives. But terminal infrastructure limits throughput so that these routes cannot offset a full strait closure. They can absorb a portion of disrupted volume, not all of it. And as of this morning, 3 more commercial vessels were struck by projectiles in the Gulf region, including a Thai-flagged bulk carrier whose 20 crew members were rescued by the Royal Navy of Oman after the ship caught fire. The war risk insurance market has responded by removing protection and indemnity cover for any voyage in the area. When insurers leave, ship owners have no choice but to route around Africa's Cape of Good Hope, adding 10 to 14 days to delivery times regardless of what the IEA releases from storage. There is something else worth stating honestly. Markets do not always follow the structural argument. Even when the data is clear, positioning, sentiment, and technical levels can keep prices suppressed for longer than the fundamentals suggest. The support level at $552 that technical analysts have identified is real. If gold closes on a daily basis below 5,160, EBC Financial Group has cited that level specifically, the downside risk becomes more serious and could signal something beyond a normal pullback. These are legitimate risks. Anyone who tells you the outcome here is certain is not being straight with you. Here are 3 specific things to watch over the next 24 to 72 hours, each of which will tell you something definitive about which direction this resolves. The first is tomorrow's U.S. GDP second estimate for Q4 and full year 2025, scheduled for release on Friday, March 13th. This will be the most complete picture of the U.S. economy before the Iran war and before full tariff impacts. If growth was already slowing materially in Q4, which the data flow has been suggesting, the Federal Reserve faces a genuine stagflation scenario next week rather than a simple hold-and-wait posture. A weaker GDP print will move gold. The second is the University of Michigan 5-Year Consumer Inflation Expectations Index, also releasing Friday, March 13. This is the forward-looking inflation measure the Fed has explicitly stated it monitors closely. If households are now embedding the Iran oil shock into their 5-year expectations, which is entirely possible given 4+ gasoline prices in many U.S. markets, that number could come in above the 3.1% range that would make the Fed visibly uncomfortable at next week's meeting. Watch for the number to print above 3.1%. That would tighten the Fed's room to cut substantially. The third is the FOMC statement and dot plot on March 18th at 2 p.m. Eastern. Specifically, watch whether the median dot shifts from 1 cut to 2 cuts for 2026, or whether it holds at 1 cut or even shifts to 0. According to CME FedWatch's current analysis, markets are assigning approximately 43% probability to a second-rate cut before year-end. If the dot plot confirms or exceeds that expectation, the structural bull case for gold accelerates. If it tightens to 0 cuts with oil still elevated, the market has to reprice a genuine stagflation framework, which, historically, has been among the most powerful environments for physical precious metals. The full picture of what is happening here is this. You are watching a precious metals market in a transition between 2 different kinds of bull markets. The first was monetary, driven by Fed policy expectations, dollar weakness, and the kind of macro positioning that responds to CPI data and interest rate differentials. That market has been volatile. It produced both the January 28th record and the subsequent correction. The second is structural, driven by energy supply fracture, central bank reserve diversification that J.P. Morgan Global Research projects at 755 tons of purchases in 2026 alone, ETF inflows the World Gold Council has confirmed at over $77 billion year to date, and a geopolitical realignment that has physically split the world's oil market into 2 lanes. That second market does not respond to a single month's CPI reading. Today's number on your screen, somewhere around 5,064 to 5,182, depending on when you checked, is not the real price in the sense that it does not reflect the cost of energy that is arriving in next month's data. It is the price of a market that received one piece of backward-looking information about a world that no longer exists and reacted to it in the predictable short-term way. The question is not whether that reaction was logical. It was. The question is what the price looks like on April 10th when the Bureau of Labor Statistics publishes March CPI, the first report to fully capture the energy shock that began February 28th. That March CPI is being priced right now by oil markets, insurance markets, and shipping rerouting decisions. It is not being priced by today's gold move. Given that Brent crude has been trading between $90 and $119 per barrel since the war began, and that analysts at the Carson Group have estimated CPI could reach 3.5% by year-end if oil averages $100 per barrel for the remainder of 2026, where do you think the Federal Reserve's rate path looks on April 10th compared to what CME FedWatch is showing today? Drop your number in the comments. I am particularly interested in whether you think the dot plot next Wednesday shifts to 2 cuts or holds at 1, and how that changes your view on what gold does between now and the April 10th CPI release. The analysis that makes the most specific case, either direction, I will pin. The Federal Reserve's March 18th decision and press conference is 6 days away. I will have the full metals market analysis up the night before. If you are not subscribed with notifications on, you will miss it. That meeting is the first time the committee has formally had to respond to both the tariff shock and the Iran war in a single set of projections. Whatever Powell says about the word transitory is going to matter. Everything cited in this video is sourced from public data. The Bureau of Labor Statistics, CPI release dated March 11th, CME Group margin data, IEA emergency release announcements, Al Jazeera and NPR war coverage, CNBC market reporting, Tanker Tracker's vessel data, and Federal Reserve FOMC minutes published publicly at federalreserve.gov. Links are in the description. I am not a financial advisor, and nothing here is investment advice. Verify every number yourself. The links are there. Make your own decisions.